Right now, while you're watching this video, the average American household owes more money than most people make in 2 years. Not because they bought a yacht. Not because they gambled it away in Vegas. They owe it because they bought groceries. Because they drove to work. Because their kid got sick and the ambulance ride alone cost more than their rent. $18.8 trillion. That's the total household debt in the United States right now: mortgages, credit cards, auto loans, student loans, all of it, added together. To put that number somewhere your brain can actually hold it, if you stacked that much money in $100 bills, the pile would reach past the International Space Station. Twice. And here's the part that should genuinely unsettle you. This isn't a crisis. This is normal. This is Tuesday. The debt didn't spike because of some disaster. It climbed, quietly, for 5 straight years, $4.6 trillion higher than it was before the pandemic, and almost nobody panicked. No headlines. No emergency meetings. Just a slow, steady climb that everyone agreed to stop noticing. So the question isn't, how did this happen? The question is, why did an entire country get comfortable owing this much money, and what happens the day it stops being comfortable? Here's why you should care, even if you've never set foot in America. The U.S. economy isn't just the biggest economy on earth. It's the engine room. When American consumers spend, factories in Vietnam run overtime. When American consumers stop spending, container ships from Shanghai sit empty in the harbor. And American consumer spending, nearly 70% of the entire U.S. economy, is not really funded by American income anymore. It's funded by American borrowing. That's not an insult. That's the literal mechanical truth of how the system now runs. Wages have grown, prices have grown faster. And the gap between the two has been quietly filled by one thing: credit. So when we ask, why are Americans in debt, we're actually asking a much bigger question. We're asking whether the world's largest economy is standing on income, or whether it's standing on a loan that keeps getting rolled over, year after year, and nobody's checked the balance in a while. Let's break down where this $18.8 trillion actually lives, because the composition tells a very different story than the headline. About 73% of it, roughly $13.1 trillion, is mortgage debt. On the surface, that sounds fine. A mortgage is debt tied to an asset. You owe money, but you also own a house. Then there's the rest, close to $1.7 trillion in auto loans. Around $1.6 trillion in student loans. And roughly $1.3 trillion sitting on credit cards, high interest, unsecured, the most expensive money a household can borrow. Now here's the mechanism most people never think about. A mortgage at 4% interest is a completely different animal than a credit card at 22% interest. But both show up in the same headline number. Both get flattened into $18.8 trillion of debt, as if a home loan and a maxed-out Visa card are the same species of financial pressure. They're not. And that distinction is exactly where the real story hides. Because when you strip away the mortgage, the safe debt, the debt tied to an appreciating asset, what's left is the debt people take on just to survive the month. Groceries on a credit card because the paycheck ran out 5 days early. A car loan stretched to 7 years because that's the only way the monthly payment fits the budget. A student loan that was supposed to buy a better future, now just buying time. That's not investment debt. That's survival debt. And survival debt behaves completely differently in a crisis than mortgage debt does. Here's the uncomfortable math nobody puts in the headline. Mortgage debt is the biggest slice of the pie, but mortgage delinquency is near historically normal levels. The big, scary number is mostly behaving itself. The smallest slices, credit cards and auto loans, are where the real bleeding is happening. Auto loan delinquency has climbed to the highest level since this data started being tracked, higher than it was during the 2008 financial crisis. Student loan borrowers who are 90+ days behind have been climbing for months straight. Read that again. The debt that's actually failing isn't the big, headline-grabbing mortgage pile. It's the small, unglamorous stuff, car payments and credit card minimums, that people quietly stop being able to pay first. Why does that matter? Because those are the canaries. Nobody defaults on their mortgage first. You default on the credit card first, then the car, and only when everything else has already collapsed do you miss a mortgage payment, because losing the house is the last domino, not the first. So when auto loan and credit card delinquencies are already climbing while the total debt number looks stable, that's not stability. That's a system where the frontline defenses are already failing, and the headline number just hasn't caught up yet. And there's a second layer underneath that. A huge share of new borrowing over the last 2 years hasn't come from people upgrading their lifestyle. It's come from subprime borrowers, people with weaker credit, taking on more cards, higher limits, just to keep pace with the cost of living. Credit, for a growing slice of the country, has stopped being a financial tool. It's become plumbing. It's how the month gets paid for. Now here's the contrast that should really bother you. The hype version of this story, the one that gets repeated on cable news and in government press releases, goes something like this: the American consumer is resilient. Spending is strong. The economy is holding up. And technically, that's true. People are still buying things. Retail numbers still look okay. GDP is still growing. But resilience funded by borrowing isn't the same as resilience funded by income. A household that keeps spending because it keeps swiping isn't proving strength, it's proving that it hasn't run out of credit yet. Those are two very different stories that produce the exact same spending chart. It's the financial equivalent of someone running a marathon and looking strong at mile 20, except they've been running on a stimulant, not on training. From the outside, the pace looks identical. From the inside, one of those runners is about to hit a wall the other one never will. The uncomfortable truth is that the economy is resilient, and households are quietly maxing out their last available credit line, can both be true statements about the exact same set of numbers. The spin depends entirely on which half of the sentence you choose to say out loud. So zoom out. Why does any of this actually matter beyond one country's credit card statements? Because debt this size doesn't just sit there quietly forever. It has to be serviced, paid down, interest and all, every single month, out of income that isn't growing nearly as fast as the debt is. That servicing cost eats into spending elsewhere. Less spending on a restaurant meal. Less spending on a small business's product. Multiply that by tens of millions of households, and you're not looking at a personal finance problem anymore. You're looking at a drag on the entire economy, built brick by brick out of individually reasonable decisions. And there's a second risk hiding underneath the first: interest rates. A huge share of this debt, credit cards especially, resets with the market. When borrowing costs rise, the exact same debt suddenly costs more to carry, with no warning and no negotiation. Households that were barely keeping up get squeezed harder, with zero extra income to absorb it. This is the part that should really sit with you. None of this required a single bad decision from any one person. Nobody in this story is reckless. Someone needed a car to get to work, so they financed it. Someone's rent went up, so the groceries went on a card. Someone believed a degree would pay for itself, so they borrowed for it. Every individual choice was rational. And yet, stacked together, 20 million rational choices built a $18.8 trillion structure that the entire global economy is now quietly leaning on. That's not a story about irresponsibility. That's a story about a system where staying afloat now requires borrowing, and where normal and fragile have started to look exactly the same on a balance sheet. So here's where this leaves us. $18.8 trillion isn't a crisis number. It's a coping number. It's what it costs, right now, for tens of millions of households to keep the lights on, keep the car running, keep the kids fed, while wages quietly fail to keep pace with everything else. The system hasn't broken. It's adapted. It's found a way to keep functioning by letting debt do the job that income used to do. But adaptation and stability aren't the same thing. A body can adapt to running a fever for a long time. That doesn't mean the fever isn't a problem. So the question worth sitting with isn't, when will this crash? Maybe it won't. Maybe the system keeps absorbing more and more debt, quarter after quarter, indefinitely. But if it can absorb $18.8 trillion without anyone treating it as an emergency, what number would it actually take to make everyone finally look up?